and welcome to Markets Today. I'm Lata Venkatesh. With me is Sonia Shenoy. It's been yet another bad day for the markets, with shares bleeding across the board. Mid-caps, small caps, heavyweights, Sensex, Nifty, all of them fell. Practically no sector was left unscathed, barring perhaps some defense lives like pharma and tech, and even that only a handful of them. It was kind of a reality reckoner. Hi, Sonia.
Hi, Lata. Indeed, once the Chinese markets fell, then there was no looking back. But I guess our own markets just needed a reason to correct. I mean, the run-up has been hard and fast. And even if you look at China, it's up, 35% since the start of the year. So I guess, some amount of correction is par for the course. But let's take our viewers through all the top headlines, and then we'll talk more about individual stocks. Indian shares fall for the fourth consecutive day. The Sensex lost more than 300 points today, while the Nifty dipped below the crucial technical support of 8400. It closed below 8350 on the index, succumbing to a global sell-off. Mid-caps also bled. 4 stocks fell for every one that rose.
The Shanghai market tumbled more than 5%, its biggest daily loss in 5 years. The fall came after China banned the use of lower-rated bonds as collateral for some short-term loans. The sell-off began in riskier debt, then spread to government bonds, and finally to stocks.
And in stock action in India, the metals shares fell the hardest thanks to Chinese growth worries, while quality stocks like Crompton, Greaves, Ashok, Leyland, Sintex and Idea Cellular also fell in the broader markets.
Well, let's also tell you the experts that we have lined up on the show for you tonight. Arvind Sanger of Geosphere Capital and Richard Gibbs of Macquarie Securities will give us the global view on India with respect to its place among other emerging markets. Also, Nilesh Shah of Axis Capital will join us to talk about the road ahead for the Indian market.
All right, straight to the day's trading action then. The Lal Street came under selling pressure for the second straight day. Weak global cues and some technical factors really took the markets to their lowest level in a month. The Nifty gave up on that 8350 mark as well. Anuj Singhal is here to give us a wrap of the day's trading action. Anuj.
Well, a real bad day for the market, really one we haven't seen in some time because of the kind of fall that we had in the mid-caps. And for last 2 or 3 days now, the market is closing at the low point of the day, clearly telling you that the market has become sell on rally for the ultra short term. Shorts are making money, and that's something which always changes the texture of the market. This market technically was weak. This market lagged hedging, and this was always going to be a problem for the market if something went eerie globally. And today, of course, you had the problem in China. Mid-cap index was down as well, so advanced decline ratio of 1:4. The real problem for the market today was all the heavyweights were down. L&T, ONGC, Tata Motors, Bharti Airtel, NTPC, Reliance, a lot of individual names, ICICI, SBI. There was absolutely no point where there was any kind of buying in any of the individual names except for pharma like Sun Pharma and Dr. Reddy's and Mahindra. But unfortunately these don't make up for too much of the index, so it was a real bad day. Now the market has broken some crucial barriers convincingly and effortlessly, 8400 being the latest one, and there is a real risk of this market now going back to 8200 to complete a 5% correction, but really the bigger danger is in the mid-caps.
Yes, sir, it's true, Anuj. The bigger danger lay in the mid-caps, and we saw a lot of them which have gained in recent days, especially public sector banks, lose. Witness, for instance, Union Bank, IDBI Bank, Canara Bank, all of them fell with consummate ease. As well, the NBFC companies, PFC and REC fell with a thud. Power companies fell. Even very good stocks, like Anuj mentioned, among them Apollo Tyres, stocks like these which have good pedigree and fairly good businesses still saw profit-taking. But there were some strange ones that also were saved from the sword, as it were. Jet Airways was up and about, not only the advantage of lower crude prices, but the advantage of probably one competition less in the airline space. As well, we saw stocks like Amtech Auto, for instance, Opto Circuits, NCC, some other mid-caps with some proven quality kind of standing outside the sword, outside the bloodshed, as it were, probably just biding time, but at least today they were saved the blushes.
All right, so time now to get you some market perspective then. Arvind Sanger, managing partner at Geosphere Capital Management, believes that global worries will continue to remain going into 2015, but he feels that India will perform better than its peers in the emerging market basket. Take a look.
There are going to be some scares and hiccups along the way. But I think my prognosis for 2015 is that Europe and Japan look like they will remain challenged. China has seen a massive rally in the equity markets, but the economic fundamentals to us look as challenged as before. Commodities like iron ore certainly don't give us any comfort that China is about to come out of its significant slowdown, so it's going to continue to remain slow. So I think growth is going to be scarce. India certainly remains, along with the U.S., frankly, amongst the developed markets. India remains amongst the emerging markets one of the brightest spots. So we're still looking for more of the same, but I think the volatility that could be caused by U.S. data getting better and Fed moving towards raising rates would be one risk factor to keep an eye on in 2015. And secondly, what does ECB do? It's been talking and threatening to do QE for a while. And if it's actually able to deliver, that'll be good for markets. If there's dissent on ECB and they're not able to deliver, that could be negative for markets. So there are a couple of macro headwinds that could cause some volatility in markets.
All right, brace yourself for volatility was what the experts told us. Now for all the action from the futures and options space, let's go across to Nigel D'Souza. Nigel.
Well, it was a very weak trading session for the Nifty, and the ceiling for the Nifty has moved lower, and that was evident in the options data because the 8,700 call did see a lot of unwinding in today's trade, and now the bears are making a case when in fact the 8,500 and even the 8,400 levels become a bit of a resistance in the near term. Because just look at the premiums today. The 8,500 call saw the premium move from around 75 bucks. It more than halved. It fell to around 35 rupees, while the 8,400 call, the premium fell from around 135 bucks all the way to around 75 rupees. Aggressive writing was seen at both those two strikes. Take a look at the 8,500 put as well. Some traders were looking out for that level. They were in fact writing that particular level. But today, in fact, there was big shedding at that particular strike. And then once the 8,400 level broke, then we did see a low-level put buying. So the 8,300 put did see big buying today. The premium moved from around 22 bucks all the way to around 40 bucks, while the 8,100 put as well did see some lower protection buying because the premium over there is only around 5 to around 9 rupees odd. And in today's trading session itself, you would make some money if you were carrying that particular strike. Take a look at individual stocks. Sun Pharma did see big short covering in today's trade, while Ranbaxy on the flip side did see big buying even in a weak market. We did see that, in fact, Bharti Airtel did see selling pressure, and that stock was low by close to around 4%. ONGC as well did come in for some shorting. That stock as well was lower by close to around 4%. A couple of stocks, though, they did come in for some unwinding pressure. So SAIL as well as Dish TV did see unwinding of long positions. That was evident in the open interest shedding, while we did see buying on the likes of Havells as well as Amtech. Both those two stocks saw good buying, up by close to around 3%, with good amount of open interest built up.
All right, Nigel, thanks so much for that. Well, shifting focus to Motown now, there was a growth in sales across categories in November with a big push that came in from exports. So while the growth was not too large, it's still in single digits, there was a growth nevertheless. So if you look at domestic car sales, saw a 9% growth year on year. The commercial vehicle segment saw a turnaround with sales up 9% year on year. Speaking to CNBC TV 18, Vikram Kirloskar, the president of the industry body SIAM, said that he hoped the industry will hit 12 to 13% growth in the near term if the trend continues to remain the same. Listen in.
If I look at the industry as a whole, if we are at 2.6 or whatever percent in four-wheelers this year and 11% for the whole industry this year, I'm hoping at the end of the year, this growth continues. We'll hit, as an industry, maybe 12-13% growth. I expect the domestic sales will improve by March compared to last year. For four-wheelers, I expect about 3-4%. If I look at exports over April to November period, for passenger vehicles, where you just said it's 25% in November, it's only 2.79% increase. If I look at overall production also, again, like I said, April to November, it's a 2.69% up for four-wheelers. Overall, in all categories, is 11.74, mainly led by the two-wheelers. So there is definitely some improvement in the last few months since April.
Okay. Let's shift focus to the pharma space. Here, the Sun Pharma and Ranbaxy stocks were the ones that gained maximum in trade after the Competition Commission of India gave a conditional nod for their billion-dollar merger deal. Brokerage's view on this development was largely positive, and here's Ekta with the details of what the brokerages made of the final permission that they have got.
Thanks. I'll start with Bank of America Merrill Lynch on Sun Pharma. They have a neutral stance with the CI approval. They believe that a major hurdle is cleared. The merger is likely to be delayed by a few months, but the deal has now to get the US FTC nod, which is likely to happen in the next few months, according to Bank of America Merrill Lynch. HSBC says they believe the CCI approval was the biggest hurdle to overcome. The divestment of brands should not impact materially on a financial basis. They are overweight on both Sun as well as Ranbaxy. In fact, for Ranbaxy, they've increased the target price to 840 versus 740 rupees. Barclays remains overweight on Sun, target price 1013 rupees. They view the approval from CCI as positive. Divestments could result in cash accruals of anywhere between $25 to $30 million, according to Barclays, and they reiterate Sun's acquisition of Ranbaxy is likely to be value accretive. Lastly, Edelweiss has said that the CCI nod lifts an overhang. They expect the deal to close before March 2015. They maintain a buy sector outperform rating on both Sun as well as on Ranbaxy. Target price is 950 for Sun and 760 for Ranbaxy.
All right, Ekta. Thanks so much for that. Well, on to the global market action then. So far, it was a sea of red across the globe today, starting with Asia, where the Shanghai composite in China was the biggest loser, down over 5%. Analysts attributed the sell-off to profit-taking, expectations of a lower growth forecast for 2015, and liquidity fears regarding new corporate bond market restrictions. The Hang Seng in Hong Kong was down more than 2% as well. The Japanese Nikkei and the South Korean won also, or rather the South Korean market also ended with losses today.
Looking at a year of very uneven growth as well as potentially disappointing growth momentums in a number of jurisdictions. So I think that really says that we still have this underlying problem at work in the global economy, and that is of low income growth and, of course, very porous demand conditions. And so really the way investors need to be looking at this is those economies that will be best placed are those that have the greatest scope to basically stimulate and grow and broaden their domestic demand bases.
Right, moving on. What's leading the fall in global equity markets are, of course, the crude prices. Brent crude prices slipped to their lowest in 5 years on worries of overdependence on supplies, a supply glut, while some OPEC members are waiting to see Brent prices steady at the $65 mark. Some experts expect prices to fall even further. Let's hear out some opinion on the ramifications of this drop.
But we have seen gasoline prices fall quite substantially in the US. And I guess the thing to remember is that a lot of economies put tax on oil. And so that kind of dilutes the impact of the fall in crude prices. And of course, one of the temptations for a lot of governments in this environment, a lot of governments struggling to improve their finances, is to actually say, right, this is an opportunity to cut subsidies or to increase taxes on oil in order to help our budget deficit without hurting our own consumers. So this oil price fall is very positive, I think, for the consumer, but a lot of governments might be looking at that revenue and thinking, well, we could have some of that.
Oversold for a reason. It's oversold because the fundamentals truly do look weak. And so it's possible for a market to remain oversold for an extended period of time, and for what looks cheap to become even cheaper.
All right, that's the prognosis as far as crude is concerned. We'll take a break on markets today, but coming up, more market opinion, and we'll also get you some trading ideas.